Okay, well, a lot of respect for the people online. I will go ahead and begin this. I want to say welcome, everybody, whether it's morning or afternoon for you. I'm Steve Parrish. I'm the co-director of the New York Life Center for Retirement Income at the American College. And I very much want to thank you for signing in. And before we begin and why people are signing on behalf of the American College, I really want to express our sincere hopes that you and your family are healthy and that you're getting through the situation at least adequately and hopefully even well. We're really glad you took the time today to continue your awareness and your education in these really trying times. So I'll fill you in on the CE process and all that shortly, but let's first kind of set up what we're going to be covering today. I'm very excited about today's topic because it's a topic that I'm just personally intrigued with, and it deals very much with the future, not just the present. Now, we titled this webinar New Annuity Solutions for Advisor Channels, but obviously we are going beyond the title a little bit to include the realities of the social and the economic conditions that we're facing at this moment. We plan to address the topic of new annuities through new channels, but since we have such experts on the line, we will also have some discussion about how advisors can help in these current market conditions as we go along. Let me introduce my fellow panelists. First of all, we have Wade Pfau. I think he is a name familiar to most people that signed on to this, maybe not everybody. Wade is my co-director at the Center for Retirement Income here at the college, but he's also a very well-known, nationally known retirement researcher, writer of 2 books, constantly being interviewed by the financial press. So it's nice to have you, Wade. I always like getting Wade to join me on these calls when we can do it.
Yeah, thanks, Steve. Happy to be here.
Great. Well, I'm excited to have David Lau on. Now, as it says, he's CEO of DPL Financial Partners, and you can read his bio on the screen. But I think to many of you, he's a known name. He's quite the innovator and even disruptor in the annuity field. And so we thought it would be great to have some of his insights. He gets interviewed by some of the major publications because of some of the things he's doing, and I just think it's really great to have him online. So again, Dave, thank you for taking time out of your, I assume, very busy schedule to join us.
Thanks so much, Steve. Thanks, Wade. Really happy to join the panel and look forward to the discussion.
Good. Well, I want to mention that let's start by just acknowledging that something's going on financially. And in many ways, the continued interest in the Secure Act and now these temporary, but I tell you, very important tax aspects of the CARE Act that became law just Friday are dominating advisor interest. We know that. And Wade and I have been prolific in discussing this information in the financial and consumer press. So I wanted to let you know that if you go to our website, just the americancollege.edu, and hit news, you'll find a number of the articles that we've been quoted on and where we talk about the CARES Act and some of the related things. So we're not really going to talk about the Secure Act or the CARES Act in any specificity other than just kind of how it's affecting things. But again, we do have some things on the website. What I really want to get into is talking about the regulatory and market economic conditions that are going on and that are leading to new annuity designs and the new advisor channels that are delivering these products. So the first considerations is the regulatory environment. And before we experience these earth-shaking events of the coronavirus, the financial industry, including certainly annuities, was going through a fairly large transition from a traditional sales model for delivery and the suitability standard that applies to a fiduciary and best interest type environment. So essentially, any reasonable reading of the tea leaves is that advisors and their supervisors are going to be held to a stricter standard of care with annuity placements. Now, the SEC's best interest standard is not a full-blown fiduciary standard, but it's close enough. And now we have the NAIC. It's advocating that states specifically adopt a best interest standard with regard to annuities. the practical effect is that the culture and the mechanism for delivery of annuities has already changed. It's going to change more. So I'll let Dave talk about more of that and what it means in terms of actual advisor models. But in general, I'm referring to delivery by advisors who are compensated more by fees than by commissions. But let's be real clear. This movement towards fees is certainly more than just driven by regulatory changes. Lots going on with financial markets. So I wanted to start with you, Wade. Wade, can you suggest some of the economic and the financial factors that are also driving changes in the current retirement planning environment? And while we hope that the situation with the chaotic markets is temporary, I guess I'd like to know, do you foresee changes in these factors that might stay with us going forward?
Yeah, Steve, sure. I mean, there's a number of trends going on. And the first, not necessarily economic related, but just on the longevity side, people continuing to live longer. And so making the idea of planning for a 20, 25, even 30-year retirement, that may not really be sufficient anymore. But then more on the economic side, we have this concept of like the 4% rule of thumb and this idea about how much a person can sustainably spend from an investment portfolio in retirement. But it's based on a different type of circumstance. It's based on historical US data, and to understand the relevance of that data with the starts of retirement, it assumes a 30-year retirement. So it's looking at what were economic conditions like up until about 1990 to know how those retirements work out with the assumptions behind those models of looking at historical data. And now what retirees are dealing with are unprecedented historically low interest rates. Just in the past day, we have the 30-year Treasury yield is at 1.31%. The 10-year Treasury is at 0.7%. Even with the TIPS, the Treasury inflation protected securities that provide inflation adjusted income, the 30-year TIPS yield right now is right around 0. And then at the shorter end of the yield curve, negative. So you can't spend all that much money from bonds right now. And something that we can get into throughout the discussion as well is there's this idea that, well, if interest rates are low, you don't want to have an annuity because you don't want to lock in the low interest rate environment. But for somebody who's retired, that sort of idea it's flawed and it's not true. It's, yes, annuities become more expensive when interest rates are low, but everything becomes more expensive. Mm-hmm. And relatively speaking, annuities are in a better position in low interest rates because the component of spending provided through the mortality credits, the idea of subsidies from the short-lived to the long-lived, those are not impacted by interest rates, and that becomes relatively more important. And so the cost of an annuity grows more slowly than the cost of a bond strategy or another type of investment strategy. And then the other big factor is we have seen the market volatility now. We've seen significant market drops, but Robert Shiller's cyclically adjusted price earnings ratio, as of today, it's still about at a value of 24.5, which is on the high side still compared to historical data. And when we look at the historical data and say that something like the 4% rule of thumb worked, well, in the period up to 1990, where we can say that the 4% rule worked, knowing on where the markets were at the starts of retirements, it's still the case that it was only in the couple of years in the late 1920s that we saw market valuations as high as they still are today, even after the recent market drops. And then interest rates, as I mentioned, are lower now than they ever were in the historical data. And those two phenomena haven't happened at the same time with the high valuations and the low interest rates. So an investment-based strategy, trying to fund retirements through that, it's under a lot more strain than US historical data would imply. And these types of trends, of course, can continue into the future. And it really opens up the door to, well, let's talk about how to be more efficient with a retirement income strategy. And that greater efficiency can evolve rather than trying to self-manage the market and longevity risk by just bearing that on one's own and assuming bad market returns, assuming a long retirement and therefore spending less. Let's pull that risk through an annuity, and what role can that play in building a more efficient retirement income plan for a given asset base to support more spending and or more legacy at the end.
Yeah, it reminds me of a comment I had or a conversation I had with my brother last week where he said, I am so glad I bought that $500,000 annuity when I did. So Dave, Before we really get into specifics with annuities, let's just deal with the reality of what's happened on, or what's happening on the ground. You run a very well-known firm that talks to advisors every day. So let me just kind of ask up front, what are you hearing? What concerns are being expressed? How's it going?
Great, thanks, Steve. Yeah, we speak to loads of advisors every day, as well as some clients, and what they're seeing is really some unprecedented times. I mean, everybody knows the volatility that's going on in the market today, but the interesting thing that that it has manifested itself as is we've gone from a 12-year bull, record-setting bull market, where it was nothing but up, for the last 12 years, to hitting a technical bear market, into a recession, and now back into a bull. So that's incredible volatility, and that's particularly tough to deal with. Next slide, please. When you're a financial advisor who is dependent on asset levels for fees. So if you look at some of the impacts we're hearing, one, you understand from advisors, like, this is really difficult for them. If you're relying upon AUM, assets under management, for your your primary revenue, when that market drops 37%, all of a sudden you're faced with a business reality of having your revenues potentially drop by about 37%. Luckily, it's rebounded a little bit from that bottom, but that's a very significant operational issue for an advisor. At the same time, to kind of add insult to injury, in the words of some of the advisors we hear from, it's a field day for traditional commission annuity salesmen. So they're getting their clients, while their revenues are decreasing, their clients are also getting hit by insurance salesmen pitching annuities to them, to their clients, and they have even experienced lost assets because clients have taken money away from the traditional portfolio and put it into an annuity. And this is for fee-only advisors, they're right now, those impacts to their business are really difficult, and you add on top of it, nobody knows how long this crisis is going to last. And that's a very difficult problem to deal with, similar to a financial planning problem, right? If you know the duration, if you know what you're trying to solve for, you might have a solid approach, but it's difficult when you don't. And for their clients, their retirement portfolios, they're dealing with the real life sequence of return risk. This is what Wade chronicles and studies and educates on quite a lot. The very damaging impact of a bear market as you enter into retirement. And so clients seeing that portfolio decline and living that sequence of returns risk, although they're not going to probably express it in that way, that's a really challenging thing for a client, which is why they're looking for defensive solutions, and they're looking for security, and the solutions that an annuity can bring are particularly appealing at this time. So a lot of times you need a crisis as a stimulus for taking action that you might have ought to have taken beforehand.
Yeah, makes sense. And related to that, I'm interested in the title of a recent article I read that you wrote, stating why just okay is not okay for retirement income. And it turned out to be very prescient considering what's going on. But can you explain for the people on the line what you were getting at? And again, any thoughts as to whether these current market conditions factor into that idea?
They definitely factor into that idea. And the notion for the article came because I was reading an article in an industry pub from some investment advisors who are kind of investment only portfolio managers, and they're talking about all the different ways they're trying to generate retirement income today. And what you realize is that because, as Wade was referring to earlier, that interest rates are down so low and have been for so long, going on more than a decade now, where we've been in a really depressed interest rate environment, where who knows how long that's going to continue. is you've seen kind of an incremental, invisible increase of risk in retirement portfolios over time. So this article is talking about all the different ways that advisors are trying through investments to generate income for clients in retirement. And I thought, that's really not okay, because what you're doing is adding risk, and it's happened slowly over time. I saw a study from the Callum Institute, the other day, which kind of showed this really well. 30 years ago, you could generate a 7.5% return in a retirement portfolio with 75% cash and 25% U.S. fixed income, which is incredible. 15 years later, in 2004, in order to generate that 7.5%, you have to be 50% in equities in that retirement portfolio. And today, you'd have to be in 96% equities. So over the course of 30 years, you've seen the risk in retirement portfolios increase 6 times if you're trying to generate that level of return. But the point being is, advisors, in order to adapt to the low interest rate environment, have tried to look for income in ways that continue to add little by little, risk on top of a little more risk on top of a little more risk, until you get to the point today where a retirement portfolio looks today like a 45-year-old's portfolio 15 years ago. So it's got that much risk in it, but it's become the new normal, and that's why I wrote the article, Just Okay is Not Okay. If you just allow this infusion of risk to start coming into the portfolio, it's not fair in this environment, particularly where, as Wade was talking about, retirements are stretching to 30 years and beyond. To put it on a retiree who has to self-fund that, to continue to add more risk to that retiree in their portfolio, it's just not okay anymore.
Well, that helps. And let me let's kind of talk about how things have changed. And as you talk about it, keep in mind the question that somebody's already put in the chat box that I think is interesting, about some advisors being just vociferously opposed to annuities. I mean, so obviously we've got the big change since the days of wirehouses and insurance company ruling the space for retirement products. And now we're also seeing these mega mergers of RIAs as a kind of, I'd call it a reshuffling in the advisory space. Can you give us your take on what you see as the changes in retirement planning advice, and how these changes are reshaping the advisory marketplace, and whether that may address the issue of some advisors that are just against annuities?
Absolutely. So, typically the advisors who are against annuities, there are some famous ones, you see lots of their advertising. I think it comes back to the roots that insurance and annuities have historically been commission-based. So for a fee-only advisor, allocating some of their clients' portfolio to annuity is what some of them refer to as annuicide, meaning killing your practice by moving your assets into unbillable products. So so it was a real conflict, for a fee-only advisor, to utilize an annuity. So historically they built up a lot of defenses about why you would not want to use an annuity in a portfolio. And in the 16 years I've been working with fee-only advisors on annuities, most of them are not based in fact. Most of them are based on a lot of on rhetoric, like all annuities are complex. And it's like, the SPIA is not complex, it's incredibly simple. So it's a lot of that. But what you've seen is, as today, advisors are moving, there's a couple factors going on. One, you've got a lot more products available to them on a fee basis, so it doesn't have to be that financial conflict for those advisors. But also you're seeing a focus for advisors of moving from accumulation, to a decumulation focus. As today, being an asset manager simply focused on accumulation, that portfolio, management advice is becoming commoditized. With robo advisors, with Schwab and the like providing guidance and planning for 10 basis points. Being a pure asset manager is a difficult proposition right now. So you're seeing firms broaden beyond just being investment only, and providing financial planning and trying to be more holistic. So the other thing that you're seeing is that there's, and we're experiencing really today, is there's lots of uncertainty and unpredictability oops, I'm sorry, I was jumping ahead. I thought the slide moved ahead. My fault. So there's a lot of uncertainty and unpredictability in financial plans, and for a lot of planning, what advisors have been laying out for clients is really more of a financial plan is a little bit of an overpromise. It's more like a hypothesis. This is what could happen, or what your retirement plan could look like, and what insurance does. And so there's a lot of uncertainty given that. There's return risk. You don't know the duration of the retirement. You don't know how the markets are going to perform. You don't know about health risks, etc., or expenses that might come in. But insurance and annuities can deliver some certainty into that retirement plan. So as advisors are moving into planning and their clients are craving some certainty, and this can help with planning for annuities can help plan for an uncertain retirement in terms of duration. You see that advisors that have historically been opposed to annuities are becoming open to annuities, and because they fit their business model. Then when you demonstrate for them the different benefits of annuities, the protection against long periods of downturns, the improvements in financial outcomes when you input the annuity into their planning software, you can see increases in Monte Carlo scores. You can see decreased shortfalls in the retirement. And as Wade chronicles quite a lot, you can see potential increased spending in retirement because of the efficiency in which an annuity generates income, which also gives you the ability to potentially invest in more equities. And then the very important thing that fiduciaries haven't always taken into account is the peace of mind that they generate for clients. A lot of times, investment advisors get so caught up in the costs of products and the economics, and as they look at the potential for growth and all of the different numeric aspects of managing somebody's money, they forget about talking to their client about how they feel about it all. And adding the annuity and the uncertainty to address uncertainty is something that they're finding their clients have really been open to. And as these traditional fee-only fiduciary advisors have started presenting clients with plans that contained an annuity and plans without an annuity, and given their clients choices, they've become really surprised by how open and their clients are to plans including annuities.
Okay, so go ahead.
Go ahead. Let me just wrap up with this really quickly. And
Sure.
one of the other changes you're seeing in the market is financial advisors are all starting to look alike. Whether it's somebody at a wirehouse who's a financial advisor, or a broker at a broker dealer, or an RIA, or an insurance advisor, an insurance agent, they're all starting to look alike. They're all billing on fees. They're becoming CFPs. They provide holistic planning. And for an RIA, in order to distinguish yourself, rather than distinguish yourself by not offering insurance, the way to distinguish yourself today is by offering insurance, but on a commission-free basis, where you can show tangible differentiation from these other types of advisors.
Okay, that helps. So with that background, I mean, that's a great background. What changes? What are we seeing in pricing and products? Thinking particularly about annuities and competing products, because we're already getting comments in the chat box about whether annuities are or aren't complicated and how fee versus commission. Practically, what's that mean in terms of product innovation?
Well, the great thing that we've seen over the last 5 years, since I went out and started DPL, I'd come from having built a carrier focused on the RIA market, and back at the time, in 2014, there were just very few carriers, offering products for the fee-based market, and that's a problem, obviously, right? So in launching DPL, mission number one was create more inventory. Let's have products that that remove the commission, reprice, to provide better benefit, to the end consumer, and work in a fee-based advisor's, business model. So in 2014, I think there were 4 carriers who offered fee-based products, and they were really limited, primarily just investment-only variable annuities. Today, there are more than 20 carriers, providing fee-based products of, annuities of all types. SPIAs, DIAs, single premium immediate deferred annuities, what's called buffer annuities, variable annuities, fixed index annuities, fixed annuities, every kind of annuity you can imagine are all available today, on a fee basis, without the commission and repriced, enabling advisors to now bill on those products. What you're also seeing is, a lot of carriers who are building products for the RIA market, lowering prices of products dramatically because the commission, comes out, and providing, advisor-friendly investment options within the product. There are some products, just like anything, there are some products that still have expensive investment options. There are others that use institutional class funds. The other big innovation really that's going on is integration, and that's another thing we drive here at DPL. Is in order for a fee-based advisor to really integrate insurance and annuities into their practice, it's got to be integrated into their desktop. They've got to be able to get data feeds so they can do fee billing. They've got to be able to model it within their planning softwares, etc. So you're seeing, again, over the last number of years, more and more and more advisor technologies supporting insurance and annuities.
Okay.
So if you look at how the pricing works, and I just use some typical round numbers that you'll see, this is how the pricing is impacted when you remove the commission from a product, from an annuity product. In a typical annuity product, you'll look at maybe an 8% commission, a 2% internal distribution charge, meaning the cost of wholesaling, the cost of steak dinners, and the cost of sales contests and marketing, etc. And sometimes there's a little administrative expense, sometimes not. But you get about a total expense of 10% of expected assets. They then the way the price for the product is arrived at for like a variable annuity to get the M&E is they then take that expense, divide it by the expected duration, which is typically mirrored to the surrender period, which is often 7 years. It's a typical surrender, and you get an M&E of a typical variable annuity of 143 basis points. When you create a fee-based product, you eliminate the commission, you eliminate the internal distribution charge, and then you introduce an admin charge of about 1% in a product, and that's for the services of an insurance desk, with licensed agents who might work with advisors who aren't licensed to help implement these products. So you add that little bit of expense, and you divide it by a duration, which is about 5 years is the typical expectation of carriers right now on the duration of the products. And so you get an M&E of roughly 20 basis points for fee-based products. And I think over the course of time, what you're going to see is the price for those products is going to go down as carriers have more experience with products that have no surrender. So in a typical variable annuity that is commission-free, there is no surrender period. So carriers get a little nervous that because they don't have experience with it, that the money can walk out the door at any time. So they don't know how really to model that duration really well. As they get more experience, they're going to understand that fee-only advisors don't have to churn assets like a commissioned agent in order to generate their next income, and they're going to see that the duration is pretty long, and I expect pricing to go down even further.
Okay, and we're getting some interesting and positive challenges to how fees versus commission, but I'd like to ask both of you, just so we kind of look at the practical outcome of this movement, whether some people like it or not. I mean, it's a lot of it's going on. And can you give us a look at the actual annuity product designs and solutions that are coming from these kind of things? So I'm just saying, there's DIAs and so-called real annuities and those kind of things. What are we seeing as far as some of the product designs that are coming out of this?
So
And
I
go
think.
ahead.
Oh, go ahead.
No, go ahead, Dave.
Yes, I think you're seeing a lot of different, product design. So, like I said, just 5 years ago, you typically saw only investment-only variable annuities. Now you're seeing, fixed index annuities, which are really, good products that fit kind of a fixed income like risk profile rather than, the equity like risk profile of a variable annuity. You're seeing a lot of fixed index products, come to market. You're seeing some SPIAs and some DIAs, coming to market. You're seeing, even some fixed annuities coming to market, which is nice. But what you see is in the example I gave just a page back on the variable annuity side. The Morningstar average cost for variable annuities is 140 basis points, which the math kind of demonstrated. What you see on the fixed index and fixed products is that the interest rates that they can pay, because you've eliminated those expenses, are better. So that's one big innovation just in product pricing, and in product design. One of the more interesting products over the last number of years has been what's commonly referred to as a buffer annuity, or more formally known as a structured variable annuity, where you kind of get the blend of the upside potential of like a variable annuity, but you're investing in indices, similar to a fixed index product. You typically get higher caps, on the indices. You can potentially accumulate more, but you don't have 100% floor or a zero floor. So the client can lose assets, but it's, there's a level of protection that's provided in those buffer annuities. So those have been really popular, in the last 5 years, but particularly so today, given all the market volatility. People are looking for, those kind of solutions that offer some protection while giving, more upside than you might find in just a typical fixed index annuity.
Okay, and let me just take a moment to acknowledge we're getting, which I expected, and I very much appreciate and enjoy a lot of comments and questions. And what we typically do is see if we have time at the end to answer some of those. Otherwise, what we try to do is compile them and I address them, and when I need to, I get to the speaker. So I just didn't want people to feel like we were ignoring them. I'm trying to just make sure we get a lot of these topics covered. So with that, Wade, you do so much with the retirement income modeling. Is there anything you wanted to add as far as some of the product designs that you're seeing coming out of this major shift in the markets?
I mean, I think David covered that pretty well. It's just, yeah, indeed, with the way interest rates have been plummeting quite recently in particular, we are seeing lower payout rates even compared to a couple months ago across the board, whether that's an immediate annuity payout rate or the payouts provided through guaranteed living withdrawal benefits. And that's just because of the low interest rate environment. And I also do have the concern about what will happen with fixed index annuities, where the common criticism of them is how maybe the cap is 5%, say, but there's this ability for them to lower the cap to say 1% as a hypothetical example. And people are really worried about that kind of scenario. Well, we're getting into the perfect storm where the main factors that will drive the ability to provide upside on an indexed annuity are interest rates and market volatility implied by the VIX. And so with the extremely low interest rates, that means there's not going to be much money available to purchase upside while protecting principal. And then with the increasing cost of financial derivatives, there's not going to be all that much upside to buy. And so this is kind of a perfect storm that could lead to lower upside exposure on indexed annuities. I think those are the two biggest factors about what's going on right now.
In fact, given that, let's look forward past just the current crippling economy, because that does raise a question. My email and phone has been just jammed with questions about the Secure Act before the virus started. And many of those questions relate to annuities and life insurance, and most of them relate to the use of annuities in post-death stretch planning and that kind of thing. But I did want to bring up others that deal with DIAs and QLACs for retirement income planning. And some relate to the expected increase in employer offerings of annuities and 401k plans. So let's start with that last topic. Dave, I recognize we'll need more clarity from the IRS before employers are going to just go out and embrace annuities as an option in their 401k plans. But I'm just curious, are you gearing up for an eventual onslaught? And what do you think some of the issues will be with that?
Yeah, that's an interesting question, Steve. So, I mean, we're not really gearing up for an onslaught. I mean, I think the adoption, like most things, is going to take time. But I think that you should honestly see annuities, appearing in 401k plans, because, my perspective on 401k 401ks is they kind of accidentally become the default product, for self-funding retirement. A 401k really wasn't purposefully built, to be the default self-funded retirement mechanism for, most Americans. If it had, they probably would have used, if they had purposefully built it, it probably would have been an annuity structure, because having that, guaranteed lifetime income aspect, to your retirement plan is, an incredibly important aspect. So I think you're going to see, annuities become more prevalent in the 401k plans, particularly with the Secure Act, and particularly with the amount of annuities that are coming to market that are fee only and have the commissions removed. So I think that's an obstacle that, a lot of people have seen in 401k. And the good news is, because there's a fiduciary, associated with a 401k plan who is responsible for the investment options that are available to participants, it's likely that there will be a good annuity, within a 401k plan. So I think you're going to see employers starting to embrace this. It's going to take a little time, but it will, take hold, and frankly should take hold.
Okay, and then let's shift over to the use of annuities in personal retirement planning. And obviously that's also being driven by Secure Act. Are we dealing with business as usual, or new ideas being discussed because of what's come out of a Secure Act and the other changes?
So I think, there's, a lot of traditional uses for annuities, still that you're seeing, begin to take a lot more hold in the fee-only market, using, annuities to, strategically to generate guaranteed income, to fund essential expenses. You're, looking for downside protections, or, or products that are non-correlated to the market, at least on the downside. And, they're being used, again, to provide that downside protection, and also, look at, death benefits for beneficiaries. The big thing that's changed with the Secure Act, for the way many advisors have used annuities, is for the stretch provision. And so, of course, the provisions around the stretch, have changed, with the Secure Act. So, advisors need to understand, the changes and adapt to that. But in general, what we're seeing is a lot more just adoption of annuities in financial plans. And then, as a particular mechanism that has changed with the Secure Act, it's really the stretch provision.
Okay, and I think also, didn't you? Yes, you had some thoughts on guaranteed income coming off of a QLAC that's been finally seems to be catching on.
Yeah, you see it a little bit more. The big problem with QLACs is, of course, from an economist's point of view, they're an excellent strategy. Even I think Michael Finca, refers to it as like a no-brainer because of the benefits. The big issue with QLACs is the behavioral issue from clients, right? So it's putting aside money basically for longevity insurance is always a difficult thing behaviorally, but the QLAC is an excellent strategy, and if you can position it properly to your client, which with fee-only products, it becomes a little easier for fiduciaries who are trying to drive good solutions and good outcomes for their client. Using the QLAC makes sense for conservative clients and clients who've got good health in their family, who are particularly looking at a probable long retirement, and providing that guaranteed income into the future it's a pretty inexpensive way of funding income down the road. And the particular benefits of the QLAC are obviously the guaranteed income, but the favorable tax treatments, the benefit through of the RMD delay, and the amount of the RMD that can get eliminated for individuals. That's what makes them particularly valuable planning and economic vehicles.
Yeah. And Wade, any other thoughts on the use of annuities in personal retirement income planning? It's certainly a wide open market these days.
Right. I mean, in relation to the Secure Act, in terms of, as already discussed, that idea of less opportunities to stretch those inherited IRAs, it makes Roth conversions more attractive. And so that can be an opportunity where for individuals who are seeking to manage those tax brackets, using an immediate annuity with non-qualified assets and getting that exclusion ratio. So for those early years, you have lower taxable income from the annuity. That could be part of a strategy to then do Roth conversions in the early part of retirement and be better positioned for later in retirement, where at that point, once the exclusion ratio ends, you'll have more taxable income from the annuity, but you'll have less worry about RMDs and taxable distributions from other tax-deferred accounts. So I think that is one other area where, as there's increasing attention to having annuities inside of tax-qualified plans, but as well outside of them, the role with being able to better manage taxes on the overall retirement plan and manage those tax brackets with immediate annuities.
Yeah, that makes absolute sense. A big change from the days when you couldn't even mention an annuity in a qualified plan. I want to get to the Q&A section, and this has been incredibly enlightening, and so I want to thank you both. And I'm sure the listeners agree that we have some interesting things, and there's some questions we still have time for. I just want to remind everybody that in these trying times, it's a great time to learn more. I appreciate everybody getting online here. And I want to remind you that the RICP program is a great place to learn about a lot of the things we're talking about today. We're encouraging you to check out the RICP designation at the American College. It's really where to be these days. And by the way, before we get to a couple questions here, put on your calendars for April 29th at 2 o'clock Eastern. Our next webinar, our guest is a good friend of mine, Jim Christian. He's the past president of the Society of FSP and a well-known financial planner in Minneapolis. So I think he has some pretty interesting comments about what we've called where regulation meets recession meets reality. Best practices for advisors in an uncharted waters. So I just wanted to ask, there's a good question here, and it kind of goes with some of the other questions that we're getting, Dave. The whole idea of, a lot of people are used to the idea of commission-based. Now they're hearing about fee-based, and it's challenging to understand how it works and how you bill it. So can you help advisors understand a little bit more about how to charge on implementing these kind of solutions in a plan? I get that question a lot. They're trying to do the right thing for their client, but they don't necessarily understand how you might do that. Can you help us on that?
Sure. So all of the carriers and products we work with, I would say probably 98% of them allow you to bill your fee from out of the product, if you choose to do that. The other way that advisors bill on it is typically through a data integration, of downloading the account values into your portfolio management system and do centralized billing. And so, the mechanics of how you do it are built and are there and are enabled. Some ask, is it okay? Is it okay to bill on these assets? And it is, of course, because one, it eliminates that conflict of interest I talked about earlier. If you don't bill on these assets, then that creates a conflict of interest. And for, really, as a fee-based advisor, you're being paid to, develop a portfolio construction to deliver the best, retirement outcome. That's what our, surveys say. When we ask advisors, what's your primary job? It's delivering, a secure retirement for my clients. And that's what you're being paid for. You're not being paid by whether you can manage the assets within a product or not. You're being paid for that portfolio construction. So yes, you can and should, be able to bill, on annuities.
I think that helps. Good. And now let me ask a more specific product related question that came up here. And I think it's good because, well, anyway, let me just ask the question, and either Dave or Wade, feel free. This whole idea of these hybrid annuities with LTC riders, have to admit, on the life side, I'm very fond of those because you're dealing with multiple needs with one product. And I like that ability to do that. Can you give us a little bit of an idea how those work? So the hybrid annuities with those LTC riders.
Sure, I'm happy to do that. And if you want to add anything in, Wade, the annuity with a long-term care rider, one, there's not many out there. We're actually in the process of, we just filed one that will be available on a fee basis with a carrier. It should be available this summer after getting through the state regulatory approvals. But the way it works is you invest in an annuity, whether it's a fixed annuity, a fixed indexed annuity. Those are the two annuity types you typically see with those products. And then as you're taking income, if your client meets two of the six ADLs, or qualifies for the ADLs, you can get a multiple of the income. So that depends, product to product, but some products are going to pay you, 3 times the income that was being generated out of the annuity, or 2 times the income that was already being generated out of the annuity. So it becomes an accelerator. There's usually, a defined period of time that can happen. Some products might give it to you for 3 years, some for 5 years. But that's how those usually work. It works like a typical annuity, but then there's an accelerator, or a multiplier to the income payout, usually for a defined period of time when you meet qualifying events.
Okay.
Yeah, I mean, that's right. And just generally speaking, the low interest rate environment has made it hard to see a lot of developments with those hybrid annuity long-term care products. Most of that discussion's on the life insurance side, because with the annuity and with interest rates being so low, it's hard to cover the insurance costs for the long-term care and still provide any sort of ongoing annuity benefit on that side of the product.
Right.
Yeah,
Right.
and I'll just add quickly too. One of the attractive aspects of the annuity as opposed to the life is there's little underwriting involved. So a lot of people where they might not qualify for the long-term care insurance, the traditional long-term care insurance or the hybrid life, the annuity might be a good option because the underwriting's not there or not nearly as stringent.
Okay. Well, let me ask a question, and I'll throw in my own comment on this as well, because it's really a combination of questions I've seen here on the chat box. One was somewhat, I'll just say, critical of annuities in general, because it's a contract of adhesion, which the lawyer in me says most insurance contracts are a contract of adhesion, but meaning no client really reads it from beginning to end, so do they ever understand it? But it leads to a fair question of, how do you decide when to purchase an annuity, which account type should be located, or which account type should it be located in? I mean, the whole asset location, and whether to purchase immediate or deferred. And let me just point out a couple things. One is, that's part of what we do in our RICP, is try to provide some methodologies, have experts like Dave who can give some ideas on how best to do that. The other thing I'll just point out is I published an article in Forbes last week where I was looking at an article in the Society of Financial Service Professionals where they studied 5 of the most common retirement income calculators with the same 4 scenarios and came up with radically different retirement income solutions. So, I kind of titled it kiddingly, your retirement income is going to depend on which software package you buy. So that obviously points out the importance of having an advisor to do this. So I don't know how you address this, but I know you're on the line all the time with this. And Dave, so how do you help a advisor to decide which annuity to purchase and what account it should be located, whether it should be immediate or deferred? Big question. Any thoughts?
Yeah, well, it's hard to give one answer to that. It kind of depends client to client. But what I'll say generally is, number one, the earlier you think about it, pre-retirement, the more options you're going to have. So if you're going to start thinking about retirement income and annuities, at 64 when the client's retiring a year later, your good options are going to be limited. We typically we'll tell the firms we work with, you want to start thinking about it about 10 years prior to retirement. That's going to give you a lot more, options. And one of the things, we do here is everything we do at TPL is driven by, academics and analytics. So we've got a guaranteed income tool that can help you answer the question around which type of annuity. And I know you just made the joke about it, Steve, but ours we think is a really fair representation of the products. So we look at all the different products that we represent that create guaranteed income. We'll Monte Carlo the returns for the projected future, and we'll come out with what are the most efficient annuities to meet an income need that you're trying to for your client. And you can filter it based on product types, or you can just look across all product types. But that tool really helps us, internally, as well as the advisors we work with, make the choice of the most efficient annuity. And then our consultants will work with advisors based on client specifics to help with some of the other aspects of that question.
And time heals a lot of those problems. Wade, obviously you're one of the industry leaders in thinking through retirement income and that kind of thing, and especially how annuities can fit in. Any other thoughts besides take our ICP for figuring out really how to work with the client on making those kinds of decisions?
Yeah, sure. Well, I mean, partly, yeah, as Dave's saying, you can't give any one answer about this asset location decision. Of course, there's a tax deferral with the annuity, and so you don't get that as a unique advantage in qualified accounts. But at the same time, people may be limited as well with realizing capital gains in a taxable account to purchase the annuity. And so you have to manage all that. But I mean, related to this question as well, there's been several people who've asked about the idea that when you run plans in Monte Carlo software, you get a lower probability of success when you put in the annuity. And I think that's worth considering a little bit, because I'm concerned that could be the result, but it may be because the software, kind of one of the big pet peeves I have about some financial planning programs is they plug in historical average market returns. And so they may be assuming you're going to be getting 5 or 6% returns on your bonds in the future. And that's really not realistic today when the 30-year treasury is at 1.3%. Today's interest rates are the best predictors of bond returns, but you'll be lucky to get even like a 2% bond return in the future. And so if you adjust your Monte Carlo simulations so that you're assuming bond returns that are comparable to what's being assumed to price the annuity today, and because interest rates are lower, payouts on annuities are lower, then when you're making that fair comparison, to the extent that you're drawing from bonds to purchase the annuity, that should then be sufficient so that you see a higher probability of success with a strategy that has a role for the annuities as well. It's primarily because annuities give you a bond-like underlying return in the insurance company general account, but they add mortality credits on top of that. And another question that came up was, well, if insurance companies are investing in the same thing as advisors or clients, how does the annuity work better? And the same answer is there. It's the mortality credits. It's the subsidies that an annuity can provide that an investment portfolio can't provide. And that's going to be what helps to get a higher probability of success, especially because people tend to be worried about outliving their money and so use conservative spending rates. Once you have a higher payout rate on the annuity than what you view as a safe withdrawal rate, partial annuity strategies lower the withdrawal rate on the remaining investment accounts. And even after accounting for inflation having to come from the investments, a lower withdrawal rate, you're really setting yourself up to have greater sustainability on the non-annuity side. And that also feeds into the idea that you get higher success rates. So thinking through partial annuity strategies really is a key part of retirement income.
Yeah, good point.
And let me add one thing to that too, Wade. That's a great point on the planning software. We see that quite a lot because we help advisors, model, products within their planning software, and you do often see, those, fixed income assumptions and the market assumptions being those historical numbers, and that does impact it. The other thing that it may impact it, depending on which package you use, the definition of planned failure. The definition of planned failure is oftentimes that the client runs out of money, meaning in their portfolio. And having allocated to an annuity, the annuity may run out of money, but it's still paying you an income. So that's really not a failure. So it depends on how your software defines failure as well.
Right, you get a higher probability of success and a lower magnitude of shortfall, even in situations where the investment portfolios or the contract values of the annuity deplete.
Yeah.
Okay, well, I'm just going to throw one other question, but actually was directed my way, and I'll give you a very short answer. It says, how does Steve feel about index annuities versus variable? And it kind of reminds me of, how do you feel about fee versus commission? Where I'm coming from is, I guess the lawyer in me is basically saying, think about the word football. Does that mean a bunch of people running down on a pitch kicking a ball, or does that mean people with helmets that are on a field that are throwing the ball? They're both called football. Well, my point is, when you look at index annuities versus variable, I'm hoping for some kind of a common playing field where when you're showing it to the client, you're using some kind of common way that you're looking at it. I think some of the misunderstandings we have are simply because the laws are not, or they vary from one contract to another, very much as advisors vary for whether they're under an RIA versus commission, all those. And I think what we can do is all try to keep talking to each other and help our clients in these very challenging times. So I very much want to thank both Dave and Wade, and certainly the audience for providing all these great questions. Gentlemen, again, thank you for getting in there, asking the tough questions, and answering the tough ones. And again, thanks for being involved. The questions we were not able to answer, we will follow up with. Any other comments, Dave or Wade, before we go at the top of the hour?
No, thank you, Dave. Thank you, Steve. Great session.
Thanks.
Yes, thanks, Wade. Thanks, Steve. Enjoyed it. Thank you for having me.
Yeah. And on behalf of the American College, stay well, be well. Thanks.